Hi, welcome to the chapter on current liabilities and payroll accounting. Later, back to the next course, we'll look at long-term liabilities. But in this chapter, we look at current liabilities, notes payable, different short-term payables like sales tax and unearned revenues, current maturities of long-term debt, and how we present it in financial statements. Then we're going to look at contingent liabilities. Contingent's a nice word. I don't get to use it very often either, but those are liabilities that might materialize. Things like product warranties that we might have some expense associated with. And then we'll look at payroll. Obviously, payroll is important to a business. How to determine payroll or record payroll, look at some different payroll taxes, and a brief look at internal control for payroll. So current liability, the textbook says a debt with two key features. First one is that the company expects to pay the debt from existing current assets or through the creation of other current liabilities. The second one is that the company will pay the debt within 1 year or the operating cycle, whichever is longer. And you remember that our definition of operating cycle is the period from starting a project to ending a project. Most businesses have a one year operating cycle. Some things like Boeing making a new airplane have a much longer operating cycle. Things like drilling oil wells can have a long operating cycle. So current liabilities include notes payable, accounts payable, unearned revenues, and accrued liabilities such as taxes, salaries, and interest payable. This first item here, just step back to that with me for a minute. Company expects to pay the debt from existing current assets. They probably expect to pay it with cash, or by converting an account receivable into cash and then using the cash, or through creation of other current liabilities. It's possible we buy something on account with the intent of issuing a note for it later on. So notes payable are written promises to pay, IOUs if you will. They require the borrower to pay interest, and they're issued for varying lengths of time, different time periods. Illustration, on March 1st, 2012, Cole Williams borrows $100,000 from First National Bank on a 4-month 12% note. And you remember that 12% is always stated as an annual rate. So what they want us to do here is prepare the journal entry on March 1st and prepare adjusting entry on June 30th, assuming that monthly adjusting entries have not been made. We're just going to do the one adjusting entry. And then prepare the entry at maturity on July 1st, which would be the day after June 30th. So for the first part, it's debit cash $100,000, credit notes payable for $100,000. Then the adjusting entry on June 30th is a debit to interest expense for $4,000 and a credit to interest payable for $4,000. And they show us in red there the computation. 100,000 times 12% times 4/12, because it's 4 months out of the year, 4/12 of the year. Then on July 1, when we pay the note off, we're going to pay the 100,000 plus the interest of 4,000. So the entry will look debit to notes payable, debit to interest payable, and credit to cash for 104,000. Sales tax payable. Sales tax are expressed as a stated percentage of the sales price. They're either rung up separately or included in total receipts. Retailer collects the tax from the customer, and retailer sends in the collections to the state's Department of Revenue. That's probably pretty clear, but there is sales tax. Some merchants, particularly if you go to a flea festival or an art show or something, they just build the sales tax right into the price. They don't show it separately. But ultimately, it is the customer that's paying the sales tax. and the seller is holding that money in trust before they send it to the government. And people who keep that sales tax and don't send it in face some serious ramifications from the state government. State governments don't like people not sending what's theirs. So illustration: on March 25th, cash register reading for Cooley grocery store shows sales of $10,000 and sales tax of $600. Sales tax rate is 6%. So presumably a grocery store records sales tax separately, and that's how we know what the sales tax is. So the entry would be a debit to cash for $10,600, a credit to sales for $10,000, and a credit to sales tax payable for $600. We have unearned revenue. That's always a possibility. Revenues that are received before the company delivers the goods or provides services. And for a lot of businesses, they want to get paid something up front or all of it up front. When a company gets paid before it does the work or provides the merchandise, then it's going to debit cash and credit a current liability account that we probably call unearned revenue of some sort. When the company earns the revenue, it debits the unearned revenue account and credits a revenue account. So examples of businesses are there in the box. Airlines obviously sell tickets in advance. Magazine publishers, hotels, might get deposits in advance. Insurance companies get premiums in advance. A whole slew of businesses get paid something in advance. A lot of contractors want something down from the customer before they'll start work. So a example here of unearned revenues. Assume that the Superior University sells 10,000 season football tickets at $50 each for its 5-game home schedule. The university makes the following entry for sale of season tickets: debit to cash for $500,000 and a credit unearned revenue for $500,000. That's the 10,000 tickets times the $50. As the school completes each of its home games, it would record the revenue earned. And assuming we had a game on September 7th, you would debit unearned revenue and credit ticket revenue for $100,000, which is 1/5 of the unearned revenue. Another current liability are the portion of the long-term debt that becomes due during the current year. No adjusting entries are required for this, but we need to reflect it on the balance sheet. So if we let's say we have a note payable, and it's a 10-year note payable, but at the end of year 5, we're going to start paying off 10%. A portion of that would then become a current liability in year 5. So statement presentation analysis. We show the current liabilities first. We typically show notes payable, short-term borrowings, first as a current liability. Then we get into accounts payable, accrued expenses. Here we have accrued wages, salaries, and employee benefits. We might have customer advances. We might have employee advances, dividends payable, other current liabilities, and finally the long-term debt due within 1 year. Gives us a total of current liabilities. Then we go on and show non-current liabilities and total, and then stockholders' equity. Some of the analysis that we do with current assets and current liabilities is to figure out liquidity. How liquid are our assets? Do we have enough liquidity to pay off our current liabilities? It's the current liabilities that will force you into a bankruptcy in a hurry if you're not able to pay them off. So we have a number here, a phrase called working capital, and we measure that by taking current assets and subtracting current liabilities to come up with working capital. The larger the working capital, the better off we are. And we also compute the current ratio, which is the current assets divided by the current liabilities. and here it's a 1.15 to 1. So again, the larger the current ratio, the better our liquidity is, better our ratio of assets to liabilities, current ones are. We can use the current ratio to let us compare liquidity for different size companies and also for the same company over different periods of time. If you start to see the current ratio declining, if you see a trend that it's declining, management or shareholders need to find out why that's declining. Contingent liabilities. It's the likelihood that future event will confirm the incurrence of a liability. That's a fancy bunch of words, isn't it? The Financial Accounting Standards Board uses 3 areas of probability. The first one is that it's a probable expense, probable liability. The second one is that it's reasonably possible. And the third one is that it's remote. If it's probable, then we need to do an accrual for it. We need to reflect the expense and show the liability. If it's reasonably possible, we certainly need to do a footnote for it, if not make an adjusting entry. And if it's a remote possibility, then we can pretty much ignore it everywhere. Now, almost every business is involved or could be sued for something. And but they're just remote, so we tend to ignore that possibility. Now, if we've been sued, and there's a good chance, it's probable that we'll lose the case, and we probably need to reflect that. So recording a contingent liability. Here we talked about product warranties. It's a promise made by a seller to a buyer to make good on deficiency of quantity, quality, or performance in a product. And we all have had, or at least I have, probably presumably you have had experience with warranties where we had to take something back because it was defective and wanted a refund or wanted it replaced. Well, the estimated cost of honoring those warranties should be recognized as an expense in the period in which the sale occurs. So Denson Manufacturing Company sells 10,000 washers and dryers at an average price of $600 each. The selling price includes a 1-year warranty on parts. Denson expects that 500 units, 5% of its 10,000 units, will be defective, and that warranty repair costs will average $80 per unit. In 2010, the company honors warranty contracts on 300 units at a total cost of $24,000. At December 31st, compute the estimated warranty liability. So we take the number of units sold, 10,000, multiply it by a 5% defect rate, come up with 500 units. And then we're estimating $80 a pop to repair these things. So we come up with a total estimated product warranty liability of $40,000. And we need to record that liability, which we do by this entry: debit warranty expense and credit estimated warranty liability. Now, sometime during the year, we did honor warranties on 300 units at a total cost of $24,000. So we need to make an entry for that. And that would be to debit the estimated warranty liability for $24,000 and credit repair parts. Now, our estimated warranty liability is reduced to just the things that are outstanding for the next year. It says assume that the company replaces 20 defective units in January 2011 at an average cost of $80 in parts and labor. Again, we debit estimated warranty liability to decrease that, and credit repair parts and labor or something for $1,600. Moving on to payroll. Term payroll talks about both salaries and wages. We typically think of salaries as managerial, administrative, sales personnel, where we don't track what they make on an hourly basis. We track what we pay them by the month or a yearly rate. Wages, on the other hand, tend to be a rate per hour. Store clerks, factory employees, manual laborers. So determining payroll involves three amounts. You need to compute the gross earnings. You need to look at the payroll deductions. And then you subtract the payroll deductions from gross earnings to come up with the net pay. So gross earnings, here's an example. We have an employee. His regular pay is 40 hours at $12 per hour, so it's a gross of $480. And this employee had some overtime. 4 hours overtime. We apparently paid him time and a half for $18 an hour for a total of $72. So the employee's total wages are $552. Then we look at payroll deductions. We have some that are mandatory, at least mandatory in most states, and in all states FICA, which is the Social Security tax, and federal income tax have to be withheld. And in most states have a state income tax. You would need to withhold that. A handful of states don't. I think Florida, Texas, South Dakota, and Washington states don't have a state income tax. Then there's voluntary deductions, and they're voluntary in that they're not required by law. They may be mandatory because they've been negotiated by a union contract. But employees can have something withheld from a paycheck to go to a charity. Typically, it would be like a United Way deduction. Could be a contribution toward a retirement plan. Could be union dues. Could be health and life insurance. Could be pension plans. Those would all be voluntary in the fact that they're not required by law. Although, as I said, they may be mandatory because the union has negotiated them. So FICA is a supplemental retirement, Social Security, employment, disability, medical benefits. In 2008, and that rate hasn't changed yet, the rate was 7.65%, 6.2% of that Social Security, and 1.45% Medicare on the first 102,000 of gross earnings for each employee. And we're going to use here, notice in red, that for textbook purposes, we're going to assume a rate of 8% on the first 100,000 of gross earnings for a maximum of 8,000. We just do that for simplicity's sake in the textbook. Congress does change the earnings limits. They do change the contribution rates. Currently, there's a commission looking at how we make Social Security more financially viable. I think the last I read it was in solid position until 2037, which time it was in trouble, but until then it was okay. But it is a political football that people like to kick around, and it can get a little bit distorted and a little bit frightening to people. So federal income tax, employers are required to withhold income taxes from employees' payroll. And this withholding amount is based on your wages and then the number of allowances, the number of dependents and exemptions that you can claim on your tax return. So if you got a family of 12 and you're married filing joint, they may not withhold much taxes from your salary. And the state income taxes we talked about earlier, and some cities have an income tax. So the net pay is gross earnings minus the payroll deductions. Here's the gross earnings for our employee of $552, and there was FICA taxes, federal income tax, which we call FIT, F-I-T, state income taxes, which we call SIT, S-I-T, and a United Way deduction and a union dues deduction. So total deductions are $119.20, and net pay is $432.80. So payroll department needs to keep records on employees. There's an individual employee earning record, and it will show for each pay period how many hours they worked, what the pay was, the regular and overtime pay. There's a cumulative total, how much have you made year to date, and it shows the various deductions. It shows the net amount, and in this worksheet it shows a check number off here on the right. Companies probably keep some sort of a payroll register, although this all gets automated these days. And it shows for each pay period which employees got paid, how much, what the deductions were, and so on. So illustration here, prepare the entry the Academy company would make to record the payroll for the weekend ending January 14th. So debits the office salary expense and debits the wages expense. Some businesses will separate office versus factory expenses. Others will just make it big one big expense. And then we show different kinds of payables and of things that we've withheld from their paychecks, and then come up with salaries and wages payable. Then when we actually record the payment of the payroll, we debit to salaries and wages payable and credit cash for the amount. Example here of a paycheck and the statement of earnings that usually is attached to the paycheck. So a payroll tax expense results from three taxes that governmental agencies levy on the employers. So what gets deducted from an employee's paycheck for Social Security is not a payroll tax expense to the employer, it's the employees. But the employer does have some different payroll taxes. They don't get deducted from the employees' payroll. In this case, FICA, the Social Security, the employer matches what the employee pays. And for FUTA taxes, the federal unemployment tax, it's the rate is 6.2% of the first 7,000 of taxable wages, but employers who are compliant with the state unemployment tax get a credit of 5.4%. So FUTA generally nets out to 0.8%. And finally we have SUTA, which is state unemployment tax. And I think the textbook is just simplifying things here when it says the basic rate is usually 5.4% of the first 7,000 of wages payable. It's actually a lot more complicated than that, and it's based on the employer's past performance. How often employees have been laid off, how often they've been discharged for various things. So that rate can be very high for some industries, like construction industries, where they typically lay a lot of employees off in the winter. But for other companies, like say a doctor's office, where they never lay anybody off, that rate can evolve to a very, very low rate. Illustration here of the employer part of the payroll taxes. The Academy records the payroll tax expense associated with January 14th payroll following entries. It says use the following rates, the 8%, the 5.4%, and the So we have FICA taxes payable there, $1,376.80. We have state unemployment tax of $929.34. We have federal unemployment tax of $137.68. All that totals to $2,443.82. So debit payroll tax expense for that amount, credit to those different payables. Companies must report FICA taxes and federal income taxes that were withheld from the employee's check no later than 1 month following the close of each quarter. And again, the IRS gets really cranky if it doesn't get that money. You've withheld it from the employees, you best be sending it in. Companies generally file and remit federal unemployment taxes annually on or before January 31st of the subsequent years. When I say generally file, that's an annual tax return, and then they remit anything that they owe. Companies usually file and pay state unemployment taxes by the end of the month following each quarter. Employers must provide each employee with a wage and tax statement of Form W-2 by January 31st. That's so the employees can file their tax return. So a couple issues here about payroll and internal controls. We want to safeguard company assets against unauthorized payments of payrolls, and we want to ensure the accuracy and reliability of accounting records pertaining to payrolls. Payroll has some internal control challenges. In some businesses, and we've talked a little bit about construction companies, but imagine that headquarters is in Des Moines and that the construction job site is actually out in Colorado. So the payroll, the wage and hour information is kept in Colorado, sent via fax or email to the company in Des Moines who generates payroll based on that data. Nobody in Des Moines can actually confirm or verify that all those employees exist or that they actually work those hours. We have to rely on the supervisor and the foreman, the construction site foreman in Colorado to do that. And sometimes supervisors have been known to let employees falsify payroll records. So that's a challenge in payroll, is making sure that we pay them for the hours they did work. Sometimes people create bogus employees. Okay, a couple other fringe benefits that need to get recorded. Paid absences, i.e. the employer lets you build up some vacation time. If you haven't used it but you're entitled to it, then we need to reflect that liability at the end of the year. And also retirement benefits after you leave us. So paid absences, employees often are given rights to receive compensation for absences when they meet certain conditions. You know, have you worked there long enough? Blah blah blah. Compensation may be for paid vacations, sick pay benefits, paid holidays. When the payment for such absences is probable and the amount can be reasonably estimated, the company should accrue a liability for the future expenses. When the amount cannot be reasonably estimated, the company should instead disclose the potential liability. Then we have the issue of retirement benefits, be it pensions or health care and life insurance for retirees. Companies account for it on the accrual basis. In other words, we're going to reflect it now, even though the employee isn't going to get any benefits until they retire, but they're earning it now, and the company's incurring the expense now, so we need to accrue it. Pension plans agreement whereby employers provide benefits to employees after they retire. Two types of pension plans: defined contribution plan. The plan defines the contribution an employer will make but not the benefit, versus a defined benefit plan where the employer agrees to pay a defined amount to retirees based on employees meeting certain eligibility standards. From an employer's point of view, defined contribution plan is always better. From an employee's point of view, that defined benefit plan is a nice guarantee plan. So that concludes our discussion here, or actually my discussion of current liabilities and things. reasonably straightforward. A few catchy things about payroll taxes and deferrals. Study hard. Good luck.